Welcome to Pro News Weekly. Let's take a look at the latest developments in the financial markets. The dollar is proving surprising, stock indices and gold are moving lower in unison, and Bitcoin is losing support but holding its ground. The US dollar has failed to strengthen despite strong tailwinds. The fall in stock indices points to a decline in global risk appetite. The escalation of the conflict in the Middle East is driving up demand for safe haven assets. The acceleration of US inflation to 4.2% in May supports the idea of a Federal Reserve rate hike. However, this has not given the US dollar a fresh boost. The dollar's reluctance to strengthen stems mainly from the European Central Bank's intention to raise interest rates at its June 11th meeting, and from the lack of movement in oil prices. Rising geopolitical tensions usually push up Brent prices. However, the market's adjustment to supply disruptions is keeping North Sea crude within a narrow trading range. Rising inflation and the escalation of the conflict in the Middle East have triggered a decline in the U.S. stock market. The Dow Jones Industrial Average recorded its worst daily performance of 2026 amid fears of Fed rate hikes. But what if the pullback in share indices stems from the release of funds for the SpaceX IPO, capital raises by giants such as Alphabet and Oracle, and profit-taking on long positions? The rally in chipmakers' shares has gone too far. From the start of the year to early June, the Philadelphia Stock Exchange Index had risen by 96%. A pullback to 80% year-to-date would be a reasonable outcome of profit-taking. When signs of a bubble appear in the market, investors offload shares in companies with high fundamental valuations. Typically, this refers to a price-to-forward earnings ratio of 30 or higher. The fall in U.S. stock indices has fueled the gold rally, with gold being used as a liquidity tool. It is being sold to meet margin requirements on equities. In addition, the external backdrop is unfavorable. A nearly 70% probability of a Fed rate hike, a strong dollar, and rising Treasury yields all create conditions for selling the precious metal. Capital outflows from exchange-traded funds are exacerbating the situation. According to Standard Chartered Bank, $4,200 per ounce is a critical threshold. When the price of gold falls below that level, around 298 tons held by specialized exchange-traded funds become unprofitable. Investors are offloading these holdings, which is contributing to the decline in metal prices. Amid sell-offs in stock indices and gold, Bitcoin has unexpectedly found its footing. The week ending the 5th of June was Bitcoin's worst since the collapse of the FTX crypto exchange in 2022. This was caused by capital flight from digital assets to other markets. Bitcoin fell more than 50% from its record highs, and investors withdrew $5.5 billion from ETFs over 13 days. Many Bitcoin positions are currently in the red, so there's no point in getting your hopes up about a consolidation. It seems that traders are now using Bitcoin's rebound to sell into the rally. A key event of the week leading up to June 19th will be the first Federal Reserve meeting, chaired by Kevin Warsh. Investors will closely monitor any changes to the FOMC statement and the subsequent press conference. Despite unfavorable conditions for easing monetary policy, the new Fed chair's endorsement of the White House's mantra that inflation is temporary could be seen as a threat to the central bank's independence and could trigger a fall in the dollar. Keep up to date with global market developments in Pro News Weekly. Like, share, and subscribe.